है तेरी कहानी पग पग प्यारे दंगल 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 सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे दंगल 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 दंगल.
Great morning, my dear friends. Bhupesh Anand this side again. We are doing equity as a subject, and within Equity CFA Institute, they have introduced, two study sessions. One is study session number 13, and second is study session number 14. As per 13, they have given equity as market organization, market indexes, and market efficiency, which we have already covered. And the next study session number 14, they have given the equity analysis and valuation, in which again they have covered three readings: overview of equity securities, and then introduction of industry and company analysis, and the last, the most important, is equity valuation and the tools. So in this study session, we will be discussing the three readings. First is reading number overview of equity securities, and second is introduction of company and industry analysis, and the third is equity valuation. So today we will be starting with overview of equity securities. What is the meaning of equity? We have already seen. What are the different types of equity securities are there? How the equities are performing? What is the risk and return feature of equity? What is the meaning of private and public equity ownership? And what are the different types of voting rights and ownership rights? What is the difference between market value and book value of an equity share? What is the meaning of return on equity or cost of equity? So all these concepts we will be dealing with in this reading, and the name of that reading is overview of equity securities. So please take out your registers. Equity Institute has given 10 to 12% as a weightage, marks weightage. So please take out your register, the same register in which you have already written those three readings. That is overview of equity markets, security market index, and market efficiency. Because equity subject is same, it is also interrelated. We are doing these three readings. Overview. Just write down this lecture number 1. Overview of equity securities, introduction to industry and company analysis, equity analysis, and basic tools. So today I will be starting with a basic introduction of overview of equity securities. It has 8 learning outcomes. So I will be taking 6 or 7, or 8, maximum 8 lectures, and I have given 3 stars out of 5 stars. So these are the learning outcomes which are given to me as per CFA curriculum. So my humble request to you will be, please write down these learning outcomes. No doubt it is given in your study material, no doubt it is given in your curriculum, but still it is better to have an awareness of this reading. So LOS A, learning outcome A, will be describe characteristics and types of equity securities. That how many types of equity securities are there? What is the meaning of common stock, equity stock, preferred stock, cumulative preferred stock, callable equity stock, puttable equity stock, convertible preferred stock? So we will be dealing with these new names, terminology, equity terminology, and what are the features, So this is learning outcome number A, and in today's lecture I will be discussing with this learning outcome number A. And the next learning outcome number B is difference in the voting rights. That what are the differences in the voting rights and other ownership characteristics? It means a shareholder can have ownership right, but can have or cannot voting right. So what is the difference between voting right and ownership features? So this is learning outcome number B. Hope you are sitting and you are writing down all these learning outcomes, because it will help you in understanding the reading. LOSC. Now, what is the difference between public and private equity securities? So I will be devoting each and every lecture for each and every learning outcome. So learning outcome number D, what are the different methods? What is the meaning of IPO, Euro issues? What are the different methods for investing in non-domestic equity shares? How you can invest in non-domestic equity shares? So these are the 4 learning outcomes. Total 8 are there. Learning outcome number E, compare risk and return features of different types of equity securities. risk and return features of different types of equity securities. And what are the different types of risk? No doubt equity securities, they have more incidence of risk, higher standard deviation, but we have to compare it. LOSF, the role of equity securities in financing companies' assets, and the last learning outcome is distinguish between book value and the market value. That what the value which is appearing in the books, that is named as book value, and the value which is being traded in the stock market, that BSC, Sensex, that something is named as market value. And the last is company's cost of equity and return on equity. Compare what is the meaning of cost of equity, that is from investors' point of view, and what is the meaning of return on equity. So today I am starting with this first learning outcome. So please start writing down. The first point which I want to introduce is what is the importance and relative performance of equity securities in global financial markets. So we will be dealing with what I mean by equity securities, how they have performed in last 100 years, how we can calculate the richness of a person in the 200 years back, and how we calculate that whether the person is rich or not in today's context. So we'll be dealing with equity performance, how they have performed in the last years. So my first point to you will be, can you tell me, if you would have invested some amount in bonds as compared to equity, the performance, if Mr. A has invested some X amount in bonds, by investing in bonds and in investing in equity, so he would have got more amount of return in case of equities. So if I see global equity markets, there is a higher incidence of return in equity markets as compared to treasury bonds, as compared to bond markets, as compared to fixed income. No doubt these securities have huge incidence of risk also. We know that higher the risk, higher is the return. Now risk can be calculated by standard deviation, which we have already discussed in portfolio management and in corporate finance. So in first point, the basic feature I want to tell you that in equity market, there is a huge good performance, because if I want to find out whether the person is wealthy or not, in today's context we will see whether he is holding common stock, whether he is holding shares or not, because it is on that basis we can find out his richness. 100 years back, we generally find out that whether that person has gold, how much is gold, how much is the alternative investments. But in today's context, everything has been changed. So I can say that equity markets, they are performing worldwide good in last 50 years. I want to show you Bombay Stock Exchange. Just see this Bombay Stock Exchange. This is the index of last 10 years. Just see this is in 13,330, and then just see 9,092 and 8,966. This is in 2008, when there was a financial crisis. But these years, now 13, 15, 17, 20, 18, and if I see the basic idea, there is an increase in equity markets in Sensex in last 10 years. So overall, the basic thought process which I want to tell you is that if I invest in equity securities, if an investor invests in equity securities, no doubt there is a high incidence of risk, but overall he will be more richer in the longer perspective, in long run perspective. So this is my point number first, which I want to just tell you, introduce you. First point, importance and relative performance of equity securities in global financial markets. Equity markets have always given, just see what I have written, always given a good performance. They have always given a good performance as compared to money market securities, or money market instruments, or bond market instruments, or fixed market instruments. So this is the basic thought process which I want to build, that equity markets, they have given a higher return. If we, no doubt in some years there's a bad performance also, but those years are very few years. mostly there is an increasing trend in equity market. So today's richness, B point is today's richness is being calculated. If in today's context, if I want to find out that a person is rich or not, I will be seeing that in case of Warren Buffett or all other rich persons, that how much is the equity they are holding. How much is the equity they are holding? So B point, today's richness has been calculated by holding in equity shares of the companies as compared to investment in gold or other alternative investments. C point, standard deviation of the return. No doubt risk is more, but risk and return, they go by hand in hand. In equity securities, no doubt it is a residual claim. In but still, the standard deviation is more, but overall we will be getting more returns. So please write on C point, standard deviation of the returns of equity securities is substantially higher than standard deviation of bond markets. So the basic thought process which I want to build is equity as an asset class has a high return and high risk. This is a basic thought process which I want to share with you. Now this learning outcome A is, what are the different types of equity securities and what are the classifications of these securities. So I want to tell you there are 7 types of securities, 7 types of bifurcations, 7 types of classifications, 7 types of equity securities which we are going to discuss. And the list is like this: common stock, callable common shares. No doubt I have prepared PPT for that also, but my interest is that please write down, because if you write down, that will be you will be getting a better idea. Overview of equity securities. I have prepared, the PPT's PowerPoint slide for you. Discuss the importance and relative performance of equity securities in a global finance market. We have already discussed that overall they have good performance as compared to bond markets, as compared to treasury markets. In long run, equity securities have exhibited lower return and higher risk than government securities. High return and higher risk than government securities, and we are on the different characteristics or the features of equity securities. So we will be discussing 7 types: common stock, callable common shares, putable common shares, preferred stock, cumulative preferred stock, participating preferred stock, convertible preferred stock, and we will be discussing one by one that what is the meaning of a common stock, which type of equity shares are these, what is the meaning, what are their features, what are the characteristics. So my humble request will be, no doubt I have prepared PPTs for that, but if you write down in your register, you will be getting more clarity will be there. So let's start with writing something, then I will be showing you these PPTs. Types of equity securities. So you are writing down in your register types of equity securities. There are 7 types. There are 7 types of equity securities. There are 7 types of equity securities. One is common stock. Second is callable common shares. Third is putable common shares. I will be discussing that. What is the meaning of common stock, callable common shares, putable common shares, preferred stock, and then the categories of preferred stock: cumulative preferred stock, participating preferred stock, and the last is convertible preferred stock. And within that I will be discussing VC, angel investment. They are generally into cumulative, convertible, preferred, preference shares. So we will be discussing with that. Please write down these 7 points. Now I will be discussing each point one by one with a common examples, day-to-day examples, so that you can get an idea that what is the meaning of a common share. Now when I say a common share, now can you tell me what is the meaning of a common share? It is nothing but just like an equity share. In USA we say it as a common stock, but in India we generally name it as equity shares. Those shareholders who are the part owners, who have the part ownership of the company, they have the residuary claim, because firstly, if the company goes into liquidation, we have to pay to the outsiders, and it is only after paying to all the outsiders we pay to common stock. It means even after paying to preferred stock also, the remaining part, the residuary claim is being given to equity holders, and the rate of dividend is not fixed, and they have the voting right. So these are the features of a common stock. So please write down this first point. Third point, the first type of share which we are discussing with is named as common stock. Common stock is named as equity shares. They have a revisionary, they have a residuary. Now, what is the meaning of residuary? Residuary means the balance after paying all outside liabilities to government claims, to secure, to bonds, and all that. Then the remaining is named as residuary claim. That is named as residuary claim on firm's assets and represents part ownership of the company. So common stock means equity shares. Common stock means equity shares. They have a revisionary claim on firm's assets and represent part ownership. Now, the next part which I'm going to start with is named as callable common shares. As the name indicates, we have already discussed and derivative that in case of option, there are two types of option. One is call option and second is put option. When I say call option, it means the holder has the right to call. And when I say put option, the holder has a right to sell. Similarly, on the same basis, we are discussing that common stock can be callable common stock. That when the company who is issuing the shares has a right to call back, to buy back the shares at a price, at a specified price, at a specified time interval. Those types of shares, when issued with an agreement of calling it back, are named as callable common shares. You getting my point? Please write down. Callable common shares. Those shares in which a company will have a right to call back the stock. It means company has a right to call back the stock from the stakeholders, from the shareholders at a specified time. Let it be 2 years, let it be 3 years, let it be 4 years, and that period is mentioned in the agreement at a specified price. It means whatever may be the price in the stock exchange, it is irrespective of that. The price which is being specified in that agreement, that is named as callable common stock. So this is a company. This company has issued shares. Now with the right to buy back. Now they have the right to buy back, that they will buy it after 2 years. I have assumed hypothetically as 2 years. Now these types of shares are named as callable common stock, and now I am moving to puttable common stock. It is opposite to callable. When I say put means I can sell. It means this right is with the shareholders. In case of callable common stock, the right is with the company. Now in case of puttable common stock, the right is with the investors, with the shareholders, that they can sell these shares to the company at a specified price after a particular specified time interval. That is named as puttable common stock. You're getting a point? So it is opposite to callable. So please write down, my dear friends. This is my humble request. Please write down puttable common stock. I know that you are writing down in your register because that will only help you note out. I have already prepared PowerPoints. I have already prepared handwritten slide for you. The only objective is if we jot down, we write down some there will be a high incidence, high level of clarity. So please do it. When holder of the share, so this is the right is with the holder. When the holder of a share has a right to give back, the shares, when holder of the shares, has a right to give back the shares to the company at a specified price, then those shares are known as puttable common shares. And now I am moving to next category. I have already discussed 3 points. Common stock, second is callable common stock, third is puttable common stock. Now I am moving to preferred stock. Now as the name indicates, preferred Preference will be given to these stocks in respect of dividend and in respect of liquidation. When there was a liquidation, firstly, if I see the payments, if I have to pay I have to give the preference to these preferred stock as compared to equity stock. So preference shares, preferred, as the name indicates, it means those shareholders which have a right, to have a dividend, fixed amount of dividend before equity dividend. Those types of, share stock is named as preferred stock. So please write down, it is a mixture of equity. They can have the ownership right, they can have the voting right, and they have, fixed claim, just like in case of debt, in case of debt, it is compulsory that interest is to be paid. Similarly, in case of preference shares, preferred stock, it is compulsory that company has to pay a fixed amount of dividend to these preference holders. So I will say it is a mixture of, it is a hybrid of equity and preferred. There would be fixed rate of dividend, as we are aware of, that there would be fixed rate of dividend which the company has to pay to these preference shareholders. Now currently these in India, if I see that I cannot directly purchase preferred stock because they have not been listed as in case of equity shares. No doubt in India the government is doing efforts to build a fixed market, fixed capital market, a fixed income capital market, and a preferred market, so that the investors can easily buy and sell preferred stock. Now the next category is cumulative preferred stock. The name is cumulative. Now the point is, company has to pay a dividend to preferred stock in case of profits. But supposing the company has not getting the profits, is incurring a losses, in initial years the companies are facing huge losses, then company will not pay dividend to these preference holders. But in case these preference holders are cumulative in nature, then in the year of profit, company has to pay dividend for all those years in which there were losses and company has not paid those dividends. If supposedly there is a loss in first year, then company is not paying any dividend to preference holders. But if in second year there is a huge profit, then in second year the company has to pay dividend for last year, that is for first year as well as for second year. Now this type of feature which preference holders have, is named as cumulative preference. So we are discussing cumulative, as the name indicates, that their dividend right accumulates and they will be paid dividend in the year of profits. So please write down. In case company pays dividend of last year's as well as of current years. Why last year's? Because company has not paid in the last year because of losses. Then those types of preferred stock is named as cumulative preferred stock. So I have prepared a timeline. In first year, supposing there is a loss. In second year, there is a profit. Now in second year, the company is paying, dividend of two years. That is the first year as well as second year, because these types of preferred stocks are named as cumulative preferred stock. Now in case company is only paying for second year and not paid for first year, then those preferred stocks are named as non-cumulative preferred stock. You getting my point? Those are named as non-cumulative preferred stock. So preferred stock can be of two types as per this up to this time interval: cumulative preferred stock and non-cumulative preferred stock. In case of cumulative preferred stock, the dividend, the dividend is cumulative and it is being paid in totality in the year of profit. But in case of non-cumulative, the dividend is not cumulative. So the next category which we are going to start with is participating preferences. As the name indicates, participating. So it may happen that, when we say that equity can be divided into common stock and preferred stock. Now preferred stock, they will be entitled for only fixed amount of dividend. But if company is incurring huge profits and these shareholders, they are interested to have an extra share from those profits, then those types of rights which the company has, these types of shareholders are named as participating preferential holders. I repeat, if the preferential holders will also get the extra amount other than dividend from those profits, then that type of preferred stock is named as participating preferred stock. You getting my point? Participating means to have a participation in the profits. So just write down, if preferred shareholders also have a share in extra amount of profits other than dividend, other than fixed amount of dividend, so these shares are named as participating shares. So the last point which I want to start with is named as convertible preferred stock. It means that preferred stock which can convert into different other forms, into equity shares or into debt. So here they are talking of equity stock. If a preferred stock can be converted after a particular time interval into equity nature, into an equity stock, then those types of preference shares are named as convertible preference shares. So I will be giving you example of venture capitalists, angel investors who invest in the beginning, in the seed. They invest in the seed investment when the idea is not even proven. At that time they invest for 5 to 7 years. Now at that time they generally interested in to have a convertible preference share which has cumulative right and a participating right, because if the company is growing like this and company is coming with the IPO, now these angel investors, they want that they should get a return 8x, 9x or 10x as the case may be. So they, in order to secure their own rights, so they generally have cumulative, convertible, participating preferred shares. So I have told you cumulative. Convertible means those which can be converted into equity shares. Let's just write down convertible preferred stock. These shares will have a right to be converted into common stock of the company. Those are named as preferred stocks, convertible preferred stocks. So just see, I have already prepared the slides for you, common stock, but because by writing all those points, it will be automatically going in your mind. So that's why I have also prepared handwritten slides. So just see these PPTs. Common shareholders have a residuary claim on firm's assets and govern the corporation through voting rights. Common shares have variable dividends with the firm, and firm is not a legal obligation. It is not compulsory that even if in case of profits that company has to pay dividend. No, it depends upon the company to company. It depends upon the so many other factors. Even if they have profits, Reliance Industries is not paying any dividend. So it is not compulsory, not legal, as per law also. Callable common shares, I have just told you what is the meaning of a callable common share, in which the company has a right to call back the shares. Puttable common share has a right with the shareholder that they want to sell it, they can sell it. Preferred stock, they does not have voting right, but they have a right to get a fixed amount of dividend. Cumulative preferred stock, in case of losses, that dividend will be cumulative and it will be paid in the years of profit. It means in the years of profit, all those dividends which are not being paid in the last years, losses years, that will be cumulative and it will be paid. That is named as cumulative. Participating in the extra profits. Participating preferred shares receive extra dividend if the firm is liquidated. Convertible preferred shares or preferred stock can be converted into this at a conversion ratio, at a swap ratio, at an exchange ratio. It means those preference shares will be converted into equity shares. And generally, I have told you that in case of venture capitalists, generally they go for these types of preference shares holders. So the point is, for example, I have just written the example, this VC, they have invested here at T0. Now they want to invest their funds up to T5, and now after T5 they want to exit as an IPO. But they are interested in having these types of shares: cumulative, convertible, participating and preferred stock. during 5 years, because the company can be in the growing stage or in the loss in profit or in this stage. So in all these scenarios, they want to safeguard their interest, so they generally have cumulative convertible participating preference stock venture. So we'll be discussing in detail at the time of alternate investment. So like this, I have covered LOSA. We are doing overview of equity securities as a reading, and within overview of equity securities, we have discussed learning outcome number A, that what are the characteristics or what are the features or what are the different types of equity securities. Hope you have enjoyed the lecture. Be happy, be jolly.